Hello traders, Gary Wagner here for Trending Markets. It is approximately 11 o'clock in Honolulu, 4 o'clock in New York, March the 1st, and we are looking at a Dow Jones Industrial Average on a tremendous kickoff rally for Super Tuesday as we see it trading up in triple digits, up over 300 points, yes, at 16,843. Now, as I said, that's up about 327 points. We have oil higher, a dollar relatively unchanged on the day, and a phenomenal move, a correlative move, of course, in the S&P. As you can see, Dow Jones Industrial Average is trading up roughly 2% on the day. When we translate that to the Standard & Poor's, you can see that Standard & Poor's is up 43 points, up 2.25%, and that's a tremendous move in the market. We've been waiting for this market to really genuinely move above a conditional point, and we've certainly seen that happen today and happen with a vengeance. Now, here's the key, traders. When we look at this market, my sense was that when we were in this, call it the muck, so to speak, but we're trading in this defined range through the beginning of January, of course, and February, of course. Middle of February, we did make that move, but it seemed to stall each and every time it would hit this resistance area at 1937 on a technical basis. Now, you can see it was all over the board in the last couple of days, this, of course, being a daily chart. But on Friday, of course, we had the marketplace actually trade above this point, or excuse me, Thursday. Then on Friday, of course, we had that shooting star. But as I said, the bullish note to the shooting star was the fact that we absolutely traded above this particular price point. And then the other thing that we want to talk about, which is critically important, is this 50-day moving average, and that's this dotted line here. However, what we noticed in yesterday's trading activity was a little different, because what we saw was the market actually broke back below this particular current level of what I'll call support, but formerly it was resistance as of yesterday, and also broke back below a 50-day moving average. And so to me, that had to be a signal to wait. Now, we've had this tremendous move. It's moved above the 50%, which is 1970. But here's what I'm looking at, and here's my belief. If, in fact, we've got this market moving in rally mode again, there is absolutely no doubt in my mind but that it will take a stab and begin to trade above the 200-day moving average. To have any kind of a bullish market, that market needs to be above a 200-day moving average. Now, obviously, once this market broke, as it did in August, once it broke, there's no doubt we've got to first break through this 50-day before we break through anything else. But as you can see, we are trading solidly on the highs of the day. Tremendous move to the upside. A close well above any kind of form of resistance, and that's our signal to actually enter the market from the long side. Now, do I think we're getting in a little bit too late? Absolutely not, because as I said, my sense is that we should see, once we have a defined rally mode, we should easily see a move from above 1937 to at least, at first, challenge the 200-day moving average and inevitably take the 200-day moving average out, especially if it's going to track to new highs. No doubt about that. Now, one of the markets that we have been looking at very closely as to get a cue as to whether or not we are going to see this market, meaning the equities markets in the U.S., bottom out and move higher, has been crude oil. As long as crude oil has been effectively under pressure, at the same time, we see the equities markets under pressure. Now, take a look at a couple of these charts. First of all, our daily chart. You can clearly see on this daily chart, when we look at what we call that basic V, a pivotal point, we absolutely get the V, but we also got that here. And then once we hit roughly 34, it came back down. Now, we're trading at 34.40. We've definitely gotten that. We now have our W, so we'll have to see how it reacts here. But the key is that as long as oil is going to remain firm, we do have a real opportunity, of course, to see the equities markets starting to trade and trade harshly. Now, the next thing I want to look at, and this will be the last chart of the day, but the next thing I want to look at is a monthly chart of oil. Now, it's obviously not something you would ever trade with, but what I'm looking for really are key signs that we could, in fact, have found some sort of bottom. Now, look at the relatively small body size of these two candles. This, of course, is back in 2009 when this market came down from $150 a barrel to below $30 a barrel. Right here. Of course, 30s here, it came to what? About 26. But look at how small these bodies get. You get this very, very small consolidating candles body size. Now, look at the body size that we've got now. You can't count this month. It just started, obviously. But look at last month. Look at February. You've got a pure doji in the market. And if anything can signal a potential pivot point in the market in terms of a single candlestick long-term, meaning weekly or monthly, your doji is going to be the strongest of all of those. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.